Hey guys, Hadley here, New Zealand property buyers. So wanted to shoot this quick video today to talk to you about the key things that we're looking for at the moment in investment properties and the things that you should look for as well at the same time. So top three things are cash flow, interest deductibility, and the locations that you're purchasing. Now, I'll run through each of those step by step in this short video, and then if you've got any questions, you can feel free to get in contact with us at the end. So number one, cash flow. It's always been important. When you have periods of growth like we've had, or substantial growth like we've had, people tend to forget that cash is king and it's the thing that pays your bills each and every month. The growth to a degree is a little bit of a vanity metric, and you don't get it until the day that you sell. So cash flow becomes extremely important, and more so important to assess deals when interest rates are going up. We've only got to look back to December this year, where we had 2.99% interest rates. Currently, for the 2-year rate, we're sitting around the 4.5%. They've near on doubled, and the long-term average for interest rates sits around the 7%. So when we're looking at deals, yep, great, they were good at 2.99. How are they going to look at 5%? And more so now, when we're going forward, how much fat have we got in those deals to make sure that we're still getting cash flow each and every month? Super important too, just to think about, is that if the properties aren't cash flowing, then you're subsidizing someone else's living for them to live in your house, and then you're going to hope that the property goes up. Second thing that we're looking at and we're really focused on at the moment is the interest deductibility rules that the government has changed on us. Now, people are saying, hey, look, what happens if the government might change? This might happen, that might happen. The thing to remember is that governments incentivize business to do what, and we are in business, governments incentivize business by tax. So if they want you to do something, they'll give you tax incentives to do it. If they don't want you to do something, they'll take those incentives away. So when we're looking at purchasing investment properties, and this is part of the fundamental research that we do, is checking out demand for things like social housing. So the house that we're looking to buy, the location that we're looking to buy in, can we turn it into social housing, which is our preference because it's quick, the renovations are smaller, the chances for things to go wrong are smaller, and it's a quicker turnaround time. The second thing with that is the property that we're looking at, can we turn it into two properties? Can we get a new code of compliance to trigger those rules? Thirdly, can we relocate the house on the property and relocate another one to give us that deductibility? So as much as the deductibility rules might annoy you, and if property is your vehicle, you need to be looking at it from an unemotional approach is, right, I've got a tax incentive to do X, how do I do it? What's the most efficient way for me to do this? So I'm keeping more of my money and I'm getting the greatest, or I'm becoming as tax efficient as I possibly can. And then the third thing that we always look at is location. So we saw earlier this year, or even back further, June, July, 12 months ago, we had people buying property in all sorts of locations. A, because it was cheap, but B, because at the time there was such a shortage of listings. People went, well, I'll buy there because there's always going to be demand. Prices are always going to go up. What could possibly go wrong? And that tends to be the thinking of people that haven't seen a market in its entirety, or what happens when markets slow. And it's those smaller towns that are a lot further away from the bigger cities that suffer the most in these times. People move away from them, they get harder to rent, and also too, the growth in those smaller towns isn't as great because it doesn't have the economic fundamentals behind it. So just to quickly recap, 3 most important things to look at with the properties that you're looking to invest in. A, are they cash flow, and do they cash flow well, especially if interest rates keep going up? Do you have an element of interest deductibility in there? What can you do to the house, or what tenants can you put into the house to make sure that your interest is deductible? And thirdly, the location. Just because a house is cheap doesn't make it a good house. Just like a house is expensive doesn't make it a good house. We need to make sure that the location's going to be there for the long haul and that we're there maximizing our return on investment from a cash flow perspective, but also too, if we need to sell it, how do we get out of the property and do we recoup all of our money? Anyway, enjoy the rest of your week and talk soon. Thanks, guys.